Welcome back to Yash and Charles, where I talk about investing and essentials for building financial freedom. It is something I think all of us want, even if the idea of it is different in nature. Financial freedom can provide us with opportunities to pursue passions, explore new experiences, and live life on our own terms without having to constantly worry about money. So whether it's the ability to travel, start a new venture, retire early, or simply have peace of mind, it can definitely open doors to so many possibilities that might otherwise feel out of reach. Financial freedom, however, isn't a straight path, and it comes with ups and downs. Today, I want to share something that I experienced firsthand, which shows why diversification in the market is necessary when it comes on to our quest for financial freedom. I experienced a recent dip in my portfolio that forced me to make some changes. Well, when I first started out, I made adjustments here and there, mostly because I was experimenting and trying to see what worked. So this isn't the first time that I've had to tweak my approach, but this change I'm going to talk about was not because of an experiment. With any luck, I hope I will help someone to not make the same mistake I made. So, with that, are you ready? A few months ago, tech stocks experienced a significant dip, with the headlines and the experts, of course, giving their 1s, 2s, 3s, and even 4s on the situation. Stocks are plummeting. The stock market is in shambles. And investors were like, it is the end of the world. Everyone will go broke. Oh my God, get out. Of course, the noise was due to a combination of factors. For example, there were talks about the Bank of Japan raising its interest rates, which then got people running upside down globally, bringing the stock market with them. Definitely, I expected downturns because before starting, I ensured that I got enough information and reprogrammed my mind about the market. But that dip felt more intense just because of how much of my funds were concentrated in tech. That's when I realized I needed to rethink my strategy. I really thought that I was diversified and fairly safe because I had multiple funds in my portfolio. My mistake, though, was that many of my funds were invested in the same companies, particularly in the tech sector. So even though I had different funds, I wasn't truly diversified. The funny thing is, I was aware of it before buying each, and I also did some research on it, but still, I did not imagine the effect it would have when the market goes south. So I looked at my portfolio and I saw that it was still focused on tech. Tech is still an exciting sector, don't get me wrong, and I love it. I like searching for what's next with the companies because I do plan on adding more tech growth stocks in my portfolio. It is absolutely a great sector, but having 3 or 4 different funds with the same companies with just about the same percentage ratio added more risk than I was comfortable with. What I did was I removed some index funds and ETFs, then added others with different sectors like healthcare, financials, and even more Japanese funds with more stable growth. I didn't abandon tech, okay? I didn't, but I reduced my exposure to it and I tried to balance my portfolio with more diversified investments. Unfortunately, I have no organized visual of my portfolio before the market dip. And looking back, now I'm thinking that seriously, if I had known at that time that I was going to start a YouTube channel, I would have saved one. But yeah, I guess my psychic powers were in dormant mode. Anyway, that being said, in my portfolio currently, I have 2 funds with a few of the same companies. I'm going to show you guys a quick screenshot, but I also want to highlight that I would not recommend doing what I'm going to show you unless you are certainly sure that you understand the risks involved. So these are the two funds. Fund A is the S&P 500 index and Fund B is the eMax's Slim All Country Index. As you can see, both funds hold almost the same top stock companies, except Berkshire, Taiwan Semiconductors, and the two different meta-class shares. One big difference between both is their percentage ratio. So the percentage ratio is just how much weight each company holds within a fund. These funds have different ratios for all the companies shown here. As you can see, so over this side, you can see the differences there, right? The impact of the market activity will affect both funds differently. For example, let's say a strong performance by Microsoft will affect Fund B much more than Fund A. The reason for that is because Fund B has a larger ratio for Microsoft at 6.9%. So those are the two funds that I have that are similar. From that example, you can probably understand why I was affected badly by the dip in tech stocks. I showed you two examples, but before I had 4 funds that contained the same companies, which limited my diversification. They also had almost the same ratios, which further compounded the issue. And when ratios are alike, it means that even small changes in the value of the companies involved can lead to similar fluctuations in each fund. So that lack of diversification made my portfolio even more sensitive. In other words, we put all our eggs in one basket, which increases our chances of losing money when that sector doesn't perform well. The opposite is also true. If the market is bullish, you certainly will benefit. However, we know that the market is bipolar. That's why diversification is important, not only with funds, but also when choosing individual stocks or if you want to explore investments in other securities. Moving on, I also want to quickly show you guys how much my portfolio has grown by since the dips in August and September. At that time, I was down to less than 5% in a week. Yes, they kept going down for about a week. Oh dear Lord. I was upset. And I didn't think that it was the end of the world, but it was felt. I felt it. I knew that it would come back up, but I'm not going to pretend like my emotions didn't feel unbalanced for a few hours, okay? I'm not gonna do it. So it's now about 2 months since, and the market is behaving nicely. But apart from that, I feel like my portfolio is now more balanced across different sectors. Let's take a quick look at where I'm at. For my individual stocks, I'm up 11.55%, and for my fund investment portfolio, I'm up 11.98%, which is, it's not bad. It's not really bad, seeing that I was below 5%. Don't panic when the market dips. It's all part of the process. Market fluctuations are normal and expected in investing. Instead of reacting with fear during a downturn, stay calm, chill, and assess the situation. Markets recover over time, and selling in a panic can lead to realizing losses. So stay focused on your long-term goals, and that will help you to navigate the ups and downs more effectively. Diversify. Don't rely on just one sector. By not putting all your eggs in one basket, you can protect your portfolio from significant losses if that sector underperforms. Keep learning. The market changes fast, and we can always right our mistakes. The financial markets are constantly evolving. By staying informed and continuously learning about investing strategies, for example, you can make better decisions. If you make a mistake, view it as a learning experience rather than a failure. Understanding what went wrong can help you adjust your approach and improve your future investment choices.